Welcome to the Main Street Meets Wall Street podcast. I'm Sturdivant Sr, and we're breaking down the phenomenon that sounds like dense financial jargon. But right now, it is quietly dictating the trajectory of your retirement accounts, mortgage rates, and the broader U.S. market. The yen carry trade unwind. Before we analyze the decisions coming out of Washington and Tokyo, we need to strip away the Wall Street terminology and understand what a carry trade actually is. At its most fundamental level, a carry trade is an arbitrage strategy. You borrow money at an exceptionally low rate in one location or currency. Japan is the yen, so convert that to money, usually US dollars in this case. Invest in another asset class or another country that offers a much higher interest rate. So think Japan 0% interest rates, in the US, we'll say 5%, and you pocket the difference. The interest rate spread as pure profit. Now, for nearly two decades, Japan's maintained interest rates at or near 0% to combat domestic deflation. Meanwhile, high-yield assets in the United States, from about 5% Treasury bills and corporate bonds to high-flying mega-cap technology stocks, offer substantial returns. Global hedge funds and institutional traders realized that they could borrow trillions of Japanese yens for practically free and sell those yen to US dollars and deploy that capital across American financial markets. As long as Japanese interest rates stayed at zero and the yen remained weak, it was essentially a mechanism for printing free money on Wall Street. Now, why in the world would global hedge funds go all the way to Japan to borrow this money? That's a very interesting question. It's a fundamental question people should ask. The answer comes down to cost. Like I said, when the Federal Reserve raised U.S. interest rates above 5% these years ago, this started way back in the 90s. Matter of fact, we'll go back to how it started. But when they raised up to 5% to combat domestic inflation, U.S. dollar became more expensive. If a hedge fund borrows dollars at, let's say, 5.5%, these numbers are arbitrary. To buy a stock that returns 8%, the profit margin is only 2.5%. However, that same fund borrows the Japanese yen at 0.1% or 0.25 basis points, converts those yens into dollars, and buys that same 8% stock, the profit margin jumps to nearly 7.8. Multiply that across hundreds of billions of dollars in institutional leverage, and you're talking about billions of dollars in annualized profit generated purely off the spread between the two central banks' interest rates. But that trade relies on a very fragile thing. Japanese borrowing costs and the currency never suddenly rising, right? The currency in the dollar, or the currency that you're buying originally, has to stay low, as does the interest rates, or weak, I should say. So let's think about how this works in the real world. See how it works in the real world. Let's say you're a Main Street business owner and you own a commercial equipment leasing business. Your heavy equipment rental business here in the U.S. has an overseas manufacturing equipment approach with an extraordinary deal. They'll lend you $100,000 worth of commercial excavators at 0% interest rate loans. The only condition in the contract is that when the lease term ends, you must repay the loan principal and that manufacturer's local foreign currency. You take those excavators, you put them on your yard, and you lease them out to your local construction contractors down the street who pay you 6% annual yield. So as a cash part of this, you collect $6,000 every year in net lease income. You haven't spent a single dime of your own capital, and your borrowing cost is zero. You're operating a classic carry trade on equipment. 2 years later, this is how it goes a little different, right? 2 years later, two things happen simultaneously. First, the overseas manufacturer raises their borrowing costs from 0 to 3%. Second, due to global trade shifts, the foreign currency appreciates by 20% against the dollar. That's a squeeze. The $100,000 debt suddenly requires $120,000 in US dollars to settle because the foreign currency has strengthened. On top of that, your annual interest cost has jumped from 0 to $3,600. Your local construction lease, which still yields $6,000, can no longer comfortably service the principal debt and the rising interest expense. We're seeing this happen as the U.S. debt's going towards $40 trillion of serviceable debt. They got a clock up in New York where you can check it out. So what happens when this happens? What we've seen, and this is what you call, I guess, the unwind part of it, a forced sale. You don't have $120,000 in liquid cash sitting in your bank account to pay off that foreign lender. So what are you forced to do? You take your own operational delivery trucks, the stuff you already own, workshop tools and inventory, and you sell them off probably at heavy discounts just to raise the immediate cash to repay the foreign debt before the cost climbs even higher to service that debt. So if the hedge funds are on the ones losing money, on these Japanese loans, why does that cause my stock portfolio in North Carolina to drop, right? Why would that have any impact here in North Carolina? Here's a direct connection to your 401k or brokerage account. When the Bank of Japan raised its interest rates and the yen surged in value, global hedge funds faced the exact equipment supplier squeeze. Selling your cheap foreign loans became expensive debt. To cover these yen-dominated margin calls and repay Japanese lenders, Wall Street institutions couldn't just wait around. They were forced to liquidate whatever was most liquid and profitable in those portfolios, which probably meant dumping U.S. tech equities, S&P 500 index funds, and U.S. Treasury bonds all simultaneously. When trillions of dollars in leverage are forced to sell assets at the same time to satisfy a foreign debt requirement, it creates immediate, violent market sell-offs that have nothing to do with the underlying health of American businesses or the stocks that are being sold. This is why a policy shift in Tokyo can instantly reverberate down to Main Street, Wall Street, and globally. Like we said, Tokyo usually sets the baseline with low interest rates. So as we see, and another thing is people really don't know exactly how much is in the trade when they say it has to unwind. There are different metrics that people use to measure it, but people don't exactly know how much there is out there that needs to be unwound. Watch to intervene. So now we understand how a carry trade works, how it unwinds. Let's look at how central banks and finance ministers step in to prevent a localized central currency squeeze from turning into a full global scale liquidity crisis. Over the past year, the Japanese Ministry of Finance realized that a rapidly depreciating yen was crippling their domestic economy by driving up import costs for energy and food. So to defend their currency, Japanese authorities conducted massive foreign exchange interventions, spending between $53 and $59 billion in single trading sessions, sometimes upwards of $75 billion in multiple day operations, buying back yen on the open market. That strengthens their currency. When a foreign country intervenes at that scale, where do they get the tens of billions of US dollars required to complete those trades? They sell the US Treasury bonds. And Japan is one of the single largest foreign holders of US government debt, holding over $1 trillion in US Treasuries. So if Japan's forced to dump hundreds of billions of dollars in treasuries onto the open market to defend the yen, the US bond price may collapse, which will send the US Treasury yields skyrocketing. And as a result, every homeowner, business owner, and anyone with a 10-year treasury bill, that mortgage rate, small business loan, credit card rate that's adjustable alongside of it will rise. So what is Washington going to do, or how do they intervene in these situations? How do you stop such a large unwind? Treasury stepped in. Treasury Secretary Scott Bessent stepped in, and the Federal Reserve they did some specialized financial plumbing designed specifically to protect against American borrowers. So the Fed has a certain amount of liquid money that they can lend back out to governments in this situation, right? Like billions of dollars, maybe 50 billions. So instead of allowing foreign currency to be dumped by central banks, the U.S. Treasury back into the open market, Washington utilizes a mechanism called Foreign and International Monetary Authorities, FEMA, a repo facility. So that's what I was talking about. Under the FEMA repo facility, a foreign central bank, like the Bank of Japan, any foreign central bank that is approved with there, can temporarily hand over their U.S. Treasuries to the Federal Reserve as collateral. In exchange, the Federal Reserve hands them overnight U.S. dollars cash. So what results is Japan gets immediate U.S. dollars it needs to stabilize its currency, the currency market as well. And the protection is not a single U.S. Treasury bond is dumped onto the public market, which keeps U.S. Treasury yields stable and prevents American mortgage rates from spiking overnight. It's a sovereign liquidity safety valve that acts as a financial shock absorber, isolating American consumers from global currency turbulence. Secretary Bessent just went out like last week on the record saying that Japan in particular, we need to increase the level where they can, the limit that they have and the amount that they put into the stock. So central banks liquidate facilities like FEMA, repo do not solve the fundamental interest rate differentiator between nations. They simply prevent operational panic. It's also theories that, over time, regardless of interest rates, like bonds, these things should level themselves out. Over time, that should just even out, regardless of interest rates. Because the real rate, we're not going to get into all this right now with this Main Street meets Wall Street. We'll try to keep it quick because we still want to talk about the markets and what's happening in the markets right now. Some of the cool things coming up. But back to what I was saying. Well, and by the way, if you find any value in this, hit the subscribe, hit the like, check out the podcast Main Street meets Wall Street. So, like I was saying, central banks, the liquidity facility, FEMA repo, they don't solve the fundamental interest rate differential between nations. They simply prevent operational panic. They ensure that institutions can unwind their positions in an orderly fashion rather than through a chaotic fire sale. Bond vigilantes. However, as investors, we must recognize that while these backstops prevent a financial system meltdown, they do not eliminate market volatility. They buy time for Wall Street to reprice risk. That brings us directly how markets are set up right now, right? These markets are hovering at all-time highs as we look around, even today, even with the AI bubble that maybe we're in. Just because you're in a bubble doesn't mean it's about to pop, everyone, right? It's like we're in one and we know we're in one. And as we sit in the bubble, there's still a lot of gains to be made, but there will be a lot of losses as well. So when this bubble pops, people need to be positioned. And the market's showing us right now, actually, the repositioning is happening. We've seen with the hedge fund last month that blew up after they became over leveraged in memory stocks in South Korean region. We saw that they were picked up by the Citadel and Ken Griffin's fund. So we see that markets are coming in and repricing some of this stuff. We've seen financials perform extremely well here lately. Industrial. So we're seeing the market rotation. We saw these tech stocks take a real big hit, right? Thinking of some of the things Mike Santoli over at CNBC just started a new newsletter. Shout out to Mike Santoli. And he describes something that's called the subtractions of all fear rally for this market. So a couple of distinctive anxieties that he's weighing heavily on markets just weeks ago have temporarily been erased. So some of the things we've been talking about, so like the big tech AI spend relief, people were very concerned about how these hyperscalers are using their dollars, where the dollars are going to end up. Are they going to see a return on investment? Is this artificial intelligence infrastructure and investments actually answering? And this cloud strength growth? Because people remember, are we building fiber around the globe 2 and 3 times again? Or I think it was like 20 something times around the globe again. Are we building too much infrastructure? Are we building too many railroads, which is an interesting one when you go back and think about railroads, as we still haven't connected the route from across the continent in America. But I think that's coming with the merger. I digress. That's a different thing, but still in the stocks. Semiconductor bounce, right? The semiconductor stocks responded to their oversold technical conditions, and they regained nearly half of their 5-week 30% drawdown. So you got to understand. So 10% correction, 20% is a bear market, 30% you're in a big bear market. So these stocks and these markets, and they're doing it in sectors. They really re-rated themselves, right? I guess not themselves, but they were re-rated. Another fact that just been pushed out, people were saying, once stocks reach 5%, people will go to risk off. But if you look back historically to times like, let's say the 90s where something was running like this, I think 5% was around the average bond yield then. When I say bond yield, the one I'm looking at and thinking about is the 10-year bond yield, because that's closely tied to the mortgage rate that we see. I think Secretary Bessent says actually like a 7.5-year treasury bond that ties directly to the mortgage rate. And the mortgage rate has been hovering above 6 and between 6 and 7 all year. But the 10-year rate is what I'm saying. The 10-year rate I think it's hovered up to maybe 4.8, right around the highs this year. But it started lower, right around 4. It's been range bound at this point, like right inside of 1 point. It's been range bound. So we'll just say 4 to 5%, although I don't think it's technically touched 5% in the 10-year. But once it hits the 10 years, right? If the 10-year hits 5%, historically, people are conditioned to want to go more risk off. And I spoke about that before in other videos. We want to go look back and look at just some of the things we talk about. For anyone who's never seen Main Street Meets Wall Street, we're here to help Main Street meet Wall Street through financial literacy, through education. This stuff right here is free, or we're giving away to you. You just have to take your time and invest it in learning and growing more. This is something we like to do right now. I know I like to take complicated topics and try to make them simple. Something like the yen carry trade. Like we hear about this all the time, but what does that really mean? Like I said, so it's just a carry trade, like carrying the money from one country to another country's currency, then investing into a higher accent. And it works as long as the cheaper country doesn't have their currency appreciate or their interest rate appreciate, which if they usually have one, both happens at the same time. And that's when you start to see problems in the carry trade that's happening. CARRYTRADE, carry trade. I have a Southern accent down here in Wall Street South, down here in Charlotte, North Carolina. So there's definitely a different way that we speak. And then the Fed expectations, that's another thing. So I said there was three things that were pointed out in this newsletter. Calibrated Fed expectations. Softening the economic data last week, it came out. People were worried about inflation, but the economic inflation came out. These are readings. This isn't what Main Street feels. As anyone on Main Street knows, this isn't exactly what we feel, but the data has come out showing inflation is cooling, but I mean, inflation was higher from the war. I don't know if we can really tell what inflation is right now with oil and the Iran conflict happening right now. That seems to be a protracted event. I think as recent as today, President Trump said that I think in a nutshell, and I'm paraphrasing, pretty much fine with it going longer. But it'll be interesting to see come November because people definitely vote with their pocketbooks, like their vote is definitely going to have something to do with whether or not they're actually, what are they earning? How much are they spending? What are we doing? And that, like I said, with the Fed, it seems like they got more clarity. If we all don't remember last month, Chairman Warsh had a speech, and in his speech, the markets went down. Like the Dow went down like 1,000 points. Well, it was already down like 800 points before he started speaking, then it went down like 300-400 more points because he wouldn't give clarity. I think it was partially because the market hasn't quite figured out how to interpret what Warsh is saying yet. Chairman Warsh is saying yet, but he focused back on the task force. And I just want to make sure that Main Street, we all remember the task force right here. And this is something that he's looking at. So the 5 task force: Fed communication, balance sheet audits, economic data sources, AI productivity, and inflation targets. There won't be another Fed meeting this month. He will have a Jackson Hole speech where it will come out. Some may remember Jackson Hole. When I say like a Fed meeting, they won't change any policy. It shouldn't change any policy at Jackson Hole. Technically, the Fed can come out and change policy anytime they want. I mean, they could call an emergency meeting and come out and change policy rates or whatever they want to. But for anyone who doesn't know what Jackson Hole meeting is, that's up in Wyoming. Nope, Jackson Hole's in Montana, wherever it is. I think it's in Montana. Jackson Hole. So Chairman Warsh had one a few years ago, and he came out. He was talking about there was going to be pain in the markets, and the stock market sold off. But it's a chance for your Fed chair to come out and explain some of your things and just speak without even particularly having to give market rates or directions or information to that point. Who knows what Kevin Warsh will be like? He has said that he wants to give less communication. He mentioned in his last speech that he will review at the end of the year whether or not the Fed will continue to have meetings and post-meeting conferences after every meeting if they want to stay on the same schedule. I think it's 8 meetings right now, I think it's 8 meetings right now. You may want to reduce it to like 6 meetings. So we'll just see. But they were already committed before the beginning of this year to go through 2026 with that schedule. So he hasn't changed any of that. But I guess that's some of the things that his task force is going to look at and let people know. So one of the things, so that's Fed communication if they need more meetings. The balance sheet audit is going to be interesting because the balance sheet has continued to expand. Even though we're looking at efforts, we're spending more in the government. So economic data sources, like I said, I was just talking about the inflation jobless data. I don't know if people recall, last year we had a bad number come out and the head of that government department was fired pretty much within the same day, actually. So we'll see. They're looking back into economic data sources, AI productivity framework. So he was looking a lot from the markets, I guess, to see what they were saying and earnings and reports. And that's another thing with Warsh. It appears Warsh wants to let the market tell him what to do, but I don't know if that's the tail wagging the dog. Like the markets look to the Fed. But once again, they're very smart people who are paid a lot of money to figure this stuff out and should be able to do it partially without the Federal Reserve, but that means you got to work a little bit harder. You can't just type it into AI to get the answer. You got to actually crunch some numbers and know. I mean, it's more important to know the direction that interest rates are going than maybe the absolute level or the speed that interest rates are going as well versus the absolute level, because you can adjust to a level. And I know like the higher interest rates are, the higher, mortgage rates are going to be. It's going to cost you to have debt, but also it's going to increase your savings levels. And like I said, people generally go a little bit more risk off if once they reach like 5% in returns. And then the inflation target, he keeps saying he wants to get to 2% and like 2.0%. He said he was looking to the left of the decimal, but he came back and spoke again and said that the Fed is committed to the 2.0. As far as for their inflation target, Fed's been saying 2% for like 5 years, and they really haven't hit 2%. They've been well above it. Some explainable, some I don't think explainable. I mean, the government pumped a lot of money into the market with COVID and the pandemic. So those type of things are definitely inflationary, and those things take time to pay through. But it seems like the Fed maybe could have made some moves, but only time will tell if Chairman Warsh was completely in left field or if he actually got it right with that. Sorry, not Warsh. Well, time will tell with him too. I meant Chairman Powell. He was the one that had all those. So only time will tell if he was correct with those. We'll just see. And then, like I said, with Main Street, we see stock markets now at nearly all-time highs, and people are wondering why. I mean, it's just earnings. Earnings have been performing exceptionally well, over projections, 20% earnings, like earnings growth, and then just coming out and people are giving a great amount of like forward guidance. And we're seeing another thing with the earnings. We're seeing companies being rewarded a little bit more now for their actual earnings growth, and we're seeing people being penalized for things where they actually miss on earnings, which is good. Before we just saw crazy moves up and down both ways, regardless of earnings growth, or sometimes regardless of what people are saying, they just expect companies to continue to grow. But trees don't grow to the sky, right? Sometimes trees have to stop. Sometimes you have to prune trees for them to grow so they can focus back into it. But valuation is where the Main Street rubber meets the road. You know what I mean? So last October, the S&P 500 was trading like 23 times forward earnings, driven by this AI enthusiasm and falling bond yields in anticipation of rate cuts. So everyone thought once a new chairman came in, automatically we would have multiple rate cuts, which would bring the price of money down, the cost of financing our debt down, and would expand the market, right? Today, the market sits, somewhere that's 20 times forward. So it did re-rate and bring down, but while this is lower than last year, spending that valuation multiple further it's going to be hard because major tech platforms are transitioning into asset-heavy models where free cash flow is heavily absorbed by ongoing data centers and infrastructure build-outs. So that goes back into how are we building out the markets, right? How are we building out the AI? How are we financing what's going to be the return on investment side of these things? And then even more striking is the industrial sector. So which is trading well above its historical average, like 25 times 4 hours, which is very high for that industry. At any point this century outside this distorted pandemic era earnings, and once again, earnings. So when non-tech cyclical sectors trade peak multiples, forward market returns become far more dependent on actual sustained earning execution rather than multiple expansion. So what I'm saying is, are these companies going to execute? Because now they're priced for, as some would say, priced for perfection with this earning growth. And the earnings growth just continues to be exceptional. And the margins continue to be exceptional. That's the kind of stuff that you can see that would bring a market to pop or a bubble to burst, I guess. It would be something in that effect if we were to see earnings not net the return that people were expecting. Once again, if you never heard or watched Main Street Meets Wall Street, thanks for checking this out. Thanks for tuning in. It's just setting you up for what's coming up the week. The Fed meets later on this. So it's just good. It's good stuff. That brings us to a critical topic for individual investors. I speak English as my first language, I promise. Like I was saying a minute ago, the risk of corporate over-earning. So while analysts are celebrating strong second quarter earning reports, Mike Santoli raised a vital question that every investor must consider. Are these gaudy profit numbers reflecting sustainable organic growth, or are they companies temporarily over-earning? Say it again. Are these gaudy corporate profit numbers reflecting sustainable organic growth, or are they companies temporarily over-earning? 3 key factors flattering current corporate profit reports. Ooh, say that 5 times fast. So the AI accounting dynamics, right? Reported numbers are flattened by accounting markups on private tech valuations and ventures like OpenAI and Anthropic. Firms requiring vast ongoing capital outlays, but they're not publicly traded, so you can't really see those numbers. But you see how heavy the investment is in there. Deferred expense recognition. Data center construction revenue is being booked today by suppliers using cash funded by past earnings, while the offsetting depreciation expenses won't hit balance sheets until future quarters, unless they're using the fully bone appreciated. A favorable year-over-year lap, and current results are lapping unusual weak corporate comparisons versus the prior year. So if you had a bad year, which I don't want to say a bad year, but some of these sectors definitely underperformed compared to tech, right? So it will look a lot better. Long-term analysts research highlights multi-decade trends, right? So corporate profit margins have expanded to historic highs, partially supported by a declining labor share of national income. So you got to warn that you got to watch out for a soaring federal debt, dollar dominance, because that makes it more expensive, right? And record profit margins form a triad that cannot expand indefinitely without eventual structural adjustment. Something's got to give. The rubber's going to meet the road, right? How do you protect your portfolio without selling everything and sitting in cash, right? You don't need to pull your money out of the market to manage this risk. Remember, apply a systematic filter to every investment you hold. And remember taxes. People tend to forget taxes. I was on a podcast earlier, recorded a podcast earlier with someone we were talking about. You saw it when you was trading and people in trading, I don't think, oh, I made a 10% profit today, or I'm up 10%, but you got to take into account 4% probably is going to be taxes. So 100%, 40%, just go ahead and take that out for taxes. Probably should say half in taxes. And depending on how much money it is, it could be much more than half in taxes. But people don't account for taxes. So we don't need to pull money out of the market to manage risk. You know what I'm saying? You just got to apply systematic filters. You got to remember the type of market economy that we're in, the Moore economy. Remember the Moore economy? So massive macro momentum, operational realignment, and earnings. You remember we're in the Moore economy. So look for the massive institutional flow. Ignore the daily media headlines. Focus on where institutional capital is flowing. Right now, systematic buying is supporting August, but institutional capacity will tighten as we move into September. Macro, rates and liquidity. Align your exposure with yield realities. Respect the fact that if treasury yields remain elevated, air quotes for elevated, high PE industrials and tech stock valuations cap. All valuations cap. All valuations cap if they remain. Anyway, momentum trend values. Respect price action. The S&P 500 holding this breakout to new highs is a positive technical sign. So don't be out here trying to short this market. And don't be out here using leverage, especially like trading on markets. But you can use rallies to trim some of your overextended positions. You can take in some wins. You can lock in some winners. Like we said before, we said many times before, you never take a loss when you lock in the game. You may miss more of the game, but trying to catch a stock at the top or buying one at the bottom that's a folly of man or woman or person, whoever is trading. So operation and balance sheet health, that's the O. Focus on companies with clean debt profiles. And that's getting a little murkier now. Robust pricing power and organic cash generation rather than those relying on heavy debt, refinancing or accounting markups. Check that math, right? And then you realign, like we said earlier, rotate away from over-leveraged plays and cash flow leaders. Ensure that whatever position you have in your fixed income portfolio isn't overexposed to long durations. We're seeing this yield curve steepen on the stocks. So what that means is that the amount that, so generally you should get more money that for the longer year money's locked up. So if you got a 30-year bond, the rate of return should be higher than a 10-year bond. But we're seeing those rates, while it's still higher, get closer to each other. And when it's inverted, that means that the shorter term bonds, so like the 2-year, would be earning more than a 10-year. And that would definitely signal some things in the market for sure. Not a stable market when you see that. Speaking of markets and stability, we're a few months away from the election. Volatility is going to continue to run through this market. That's just what happens at this time of year. We're in the second year of a second term for a president, usually are back-to-back. That's usually like the worst year historically for return stocks. So earnings, you want to have quality verification of your earnings, whether it's a company's profit growth comes from core volume expansion or temporary cost cutting for CapEx. Right, where are these earnings coming from? How are we getting this money? Where's the money coming from? That's what we need to know, right? And what are some more economy stocks? And we talked about the more economy before. We talked about like some of the things, at the time you saw stocks like Microsoft and Micron, these stocks were running, but we mentioned how powerful of a factor momentum was and how momentum was moving these stocks back down and moving the markets. And we saw it, right? So enjoy the momentum, but remember the subtraction of all fears rally, right? You can't be chasing the valuation. Once they get too high, you can definitely trim, but they're going to be, and that's an overall valuation, right? So there are going to be stocks that are priced lower than this that you can definitely jump in. If you can find a period of low volatility, which it's been pretty relatively low if you look at it. Review your risk management, verify the balance sheets, the quality of your holdings, prepare your portfolio for potential seasonal chops. It's all them approaches. I think once we get through the election, the markets will go higher. And markets continue to trip higher right now, in case people haven't figured out. They're kind of operating on the way they should be operating. Data, reports, what inflation rates are doing. It's interesting how the market seems to be just completely discounting the war in Iran. That should be calculated. That could be something that we could see that can make the markets whoosh. I thought the yen carry trade was going to make the markets move a little bit more. Maybe that's more to see. Like we said, we had the re-rating of these markets, so that was always a good thing when we go back and look into the market from into July. So that's how I break down, like I said, the carry trade, how you do in the Main Street, Washington, Tokyo, just what we were seeing, policy moves, weekly setup, so what we have coming out. We had, like I said, we had data come out last week, inflation data. You've seen sentiment come out data, Main Street action plan. So just some of the things we can do. Also, Check out some of the great interviews I've had recently on the podcast. We got a lot of cool stuff coming up live as well. Check out the channel. That stuff will be streaming on X, YouTube, LinkedIn. The Wall Street South Journal has some really cool stuff. And I want to share an article that was actually quoted in today's one of the Wall Street Journal. And it's talking about high net worth individuals and some of the ways they think, some of the mindset they think, some of the mindsets they have. And I was speaking earlier of the podcast that'll be out. And also I'm doing a live with Dr. Brad Klontz, the trademark inventor of the money script. So he's done 20 plus years of research. He's a clinical psychologist. He teaches at Creighton. He's written several books. We're talking about his new book that he just wrote. So that'll be a podcast coming out soon, but we're going live on September 8th. So September 8th is going to be a great day for live. Check out the channel because we'll be live with him. And then later that day, we'll also be live with John Tomase from LinkedIn. So it's going to be a good day, a good time. But like I said, I want to share the Wall Street Journal article that actually came out today that I was the feature expert in. And that's not to be like, ho, 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 or whatever. That's just I just want to show you Main Street. Some of the cool things we're doing. This stuff doesn't happen without y'all. Shout out to Lauren. Like I said, that was up there today. And just look at some of the key takeaways, right? Just because, once again, we're trying to give definition, let people know who we are, what we're talking about. So high net worth individuals, liquid assets. And that's another thing people don't realize. There's a lot of millionaires next door. Teachers retired at a very high rate as millionaires. And then how they focus on preserving wealth, legacy, maybe more complex services, especially with tax strategies. That seems to be a big thing right now is tax strategies. People are giving out tax strategies on TikTok or wherever. You're not hearing very many professionals and licensed people going out and giving out these tax strategies because they're much more nuanced than what you're catching on the internet and what you're catching on TikTok and all these places. They're just much more nuanced, and they will get you with the IRS coming to see you if you're not taking care of these things. So high net worth individuals term the financial industry uses to describe someone who has at least 1 million liquid assets and might require more customized and complex financial services, tax strategies, estate planning, and wealth management. Basically, once you reach those levels, it unlocks doors for sure. And if you want to know what qualifies for someone, I'm not going to read this article to y'all. I just want to point out some of the cool things. So Goldman Sachs survey found that 39% of investors, 1 to 5%. Assets, they're in alternatives. And I was talking about alternatives a long time ago. People are running from alternatives. I point out that they have some of the same stresses as individuals, but it's a different level, right? So once you have, like at one point you're trying to gain your money or your net worth, but once you reach a certain level and you can go like the ultra high net worth individuals, it's more about protection. Where are these things going to go? How is it going to be out? So that's another thing, like the mindset goes from gaining to a protecting state. You also have to protect yourself because people are always looking to sue someone. Someone comes to your house and slips and falls. So those type of things, especially if people know that you are a high net worth individual, to look out for you. Here's some of the tax strategies that people are seeing online, but even here you see it's just a lot simpler breakdown. You would have to go deeper. You would need to speak with a CPA. And folks who usually are at this network have tax professionals doing these things for them because they value their time. It's not to say they couldn't do it themselves. It's just that they value their time and they know that whoever they're probably paying for this can do it faster for them. They're going to understand what's happening, of course, but they'll probably pay someone to do this. Trust contributions, real estate, charitable giving, like it can get a little bit tricky. And then, like I said, with estate, legacy planning, and this is pretty much with all people. People should think about where their assets are going to end up, who it goes to, who's going to get control. Because your money's going to go somewhere, either somewhere you don't want it to, someone you do want it to, or it's going to go to the state, right? So this stuff is critical. Make sure you have all your stuff set up. Make sure you know where the beneficiaries is. That's something you should probably check annually. People get divorced and those things go to their ex-spouses and everything. So those type of, no, you're good. So one of the biggest concerns that people are with estate planning is going to be taxes. Like I said, where your assets end up and who gets control. Money's either going to go to someone you don't want it to, it's going to go to the state or the federal government, or it's going to go to the people you want to go to. Be in control of that, figure out how to have these conversations. Estate and legacy planning is crucial, not only for high net worth individuals to preserve your wealth for years to come, but also just for any individual. These are things you want to have set out. You want to have your things, your ducks in a row. Sometimes you have to organize a greater number, more diverse mix of asset classes to pass along. Business continuity is a big thing that people usually see disruption with. Whoever it may be left to may want to close the business down, just sell it for profit. Another person may want to continue it. Maybe you have to set it up and see how that goes. transferring wealth across multiple generations. Maybe you want to leave something for your grandchildren. Maybe you want to set up where there's something set up for generations before that, people who aren't even born yet. The high taxation that can come with passing things off, passing things down in generational wealth, keeping financial and other property information out of public eye. So that's a big thing what people do to avoid probate. So people don't see assets and things like that. Because trust me, if people find out you have something, magically, people are going to start having great ideas that they could use your money to fund it with. And then where there's contributing wealth to charities and nonprofits. So there are just different ways people go about it. Family trust, strategic giving, DOAs. I think me and Mr. George Hoppenfuhr talked about DOAs, donor advised account, a few months ago. And then business succession planning is a big thing. A lot of people struggle with the business succession planning. So, and then you go from the high net worth, to ultra high net worth. So at least 30 million in investable assets. And that's actually what Dr. Brad Kloss was talking about today. He works with it, ultra high net worth. So how do they differ? They're just not donating to charities. They're probably running the whole philanthropical efforts on their own, and they might not have more investments, They might have hard assets, I should say, real estate and jewelry. So just different things. But whether you're ultra high net worth or you're just getting started, you need to make sure you have a beneficiary on your accounts. You need to know where things are going when we leave here, because everything's going somewhere. So yeah, I just want to show that, share that Wall Street Journal article from today. Shout out, like I said, to Lauren. She does a great job. So yeah, Main Street, I think that about wraps it up. I mean, like I said, you'll probably be hearing more about the yen carry trade. Just remember that is any word can be at the front of it. It could be a franc. Is a franc still a thing? Could be a euro carry trade. Carry trade simply going from one currency to the next, right? So at a lower interest rate, going back over. And then once you get those dollars converted into something you invested, that's going to just pretty much pay you for the spread that you're getting or the difference you're getting from the different currencies and the different interest rates. So in this example of what we're living right now, so the US, which a lot of people were borrowing from Japan when it was like 0%, that yen's now getting closer to 3%. So that definitely puts pressure on it. And then, but they were borrowing at 0% because that's the thing. I don't know if I expand on that enough. You have to, when you pay it back, you have to pay it back in that currency. So that's why if it goes from 0% interest rate to 3% interest rates, it costs you more to buy those yens. Oh, I did illustrate that earlier. We were talking about the $100,000 investment. But yeah, it costs you more to buy those yens also. So that's also compressing your margin. But yeah, carry trade. So you carry it over, you reinvest, and then you're reinvesting it probably again in something that's going to gain you even more money in the assets, like in that example with the leasing equipment, or if you're investing in stocks, bonds, corporate bonds, anything that will return you a higher rate of interest. That goes bad if you need liquidity. If you hit a liquidity event, that goes bad. You have to start selling things and unwinding. Like I said before, the world doesn't really know how big that yen carry trade is. If it has to unwind, you can try to kind of figure it out, but I don't think it's out to a T per se, what the trade is. So we see stock markets, all-time highs, trading around all-time highs. I think they're taking a little dip today. 10-year treasury yield, that says 4.6, but that thing moves. So depending on the day, but it's been range bound. Watch the 10-year because that's where housing and credit card rates and all type of adjustable rates are set off somewhere around that rate, really selling the Fed fund rate. So, and then they adjust to it. And which we set the Fed fund take, or the overnight rate, the rate at which banks borrow money from the Fed. That's the actual interest rate when you hear the interest rate. So when people talk about the interest rate and the number that the Fed comes out and gives. So I appreciate everyone hopping on, just checking out this breakdown. Hopefully you understand a little bit better than you did before about what the actual carry trade is when you hear it. CARRYTRADE. Carry trade. I was decided to start talking about it just because I know it's something that's in the news here and that people hear and probably just don't understand what it is and why it can impact you, how it can impact you at home, or how it can impact you in your retirement or just in the world, how it impacts the globe, and some actionable steps. I know last time I was out, I told people take some actionable steps. Have we done any of those actionable steps? Have people looked at their budget this month? Figure out how much we spend. How about we just start figuring out how much we spend on food every month and gas? Let's do two things. Everyone knows how much they spend to live, like their housing costs. So let's add how much we spend to eat, how much we spend on gas. Track that this month. Track that this week. See what the actual numbers are versus what you think it is. When you're watching this, write down what you think it is. And then see what it is actually 7 days from now. 7 days from when you finish listening to it. Subscribe to the podcast, Main Street Meets Wall Street. or I guess whatever you do on podcasts, subscribe, download, 5-star review, subscribe on YouTube, find me on LinkedIn. Those are the places I'm usually on. The company ABC Squared, that's my financial planning firm. If anyone wants to do any financial planning, that's what I do in the daytime. If anyone needs help with any of these type of things that we ever talk about on the channel, to reach out, have a conversation, check out the website, theabcsquared.com. All bases covered. Also, check out the Wall Street South Journal newsletter. It's approaching 1,500 subscribers. Thanks. It's only been out since February. It comes out monthly. So it's pretty good. Fall back on Main Street, just to let people know where we're at. And also, I guess, leave questions, comments. We've been seeing a lot of questions from users, been answering them in podcasts and episodes. We have, like I said, we have a lot of stuff coming up, a lot of things. We already recorded, a lot of people who are joining Main Street Meets Wall Street. So a lot of topics are being covered. A lot inside the psychology of money. We saw the Malcolm Jamal Warner case finally get settled with the prenup, so we spent a lot on that. Prenups, the psychology of money, as well as, the technical stuff that we get into, the fun technical stuff, stock markets and trading and valuations and interest rates and all the things that impact you, Main Street. Another note is check and see what your gas price is. From Saturday to today, it's gone up about 20 cents a gallon right down the street from me. But I don't know if everyone watches gas prices like me. Shout out to Mike Santola and his newsletter for some of the research and information cited here. Main Street Heart meets Wall Street Smarts. If you found any value, subscribe, like, share with someone you love. Main Street Heart meets Wall Street Smarts.